So, Intel stock. I owed you a video about Intel's earnings report. Of course, the market's reaction wasn't great. So what exactly has happened? That's exactly what we're going to discuss in this video, the good and the bad. Currently, the stock is trading at just under $43 with a market cap of $181.6 billion, has a forward PE of 32.2 times, which if we look at the 3-year mean, actually maybe let me switch it to the 5-year mean so we get a bigger picture here. 5-year mean 17.9 times. EV to EBITDA, price to sales, they're all higher than that 5-year mean. Of course, that's because previously Intel from a profitability standpoint was in a much better place than they are today. Right now, yes, they're investing a lot for what I call the next generation of Intel, the Intel that we've known, plus the Intel with the Foundry model. Now, some analysts expect the Foundry model to be spun off. I don't think that will happen. That's just my opinion. Maybe that will change in the future. But right now, yes, this company still has some ways to go until they reach their, let's say, peak profitability performance of years ago. Now, I'll start off with a couple of comments here that were made by the CEO and CFO. So for Q4, they delivered strong results, surpassing expectations for the 4th consecutive quarter with revenue at the higher end of the guidance. Now, remember last year, the start of the year, I said this is going to be a show me what you've got year, and a year where lowering the bar and exceeding expectation was a must. And I'm happy to see that's exactly what has happened. Now, in 2024, they remained relentlessly focused on achieving process and product leadership, continuing to build the external Foundry business and at scale global manufacturing, and executing our mission to bring AI everywhere as we drive long-term value for stakeholders. As for the CFO, we continue to drive operational efficiencies in the 4th quarter and comfortably achieved our commitment to deliver $3 billion in cost savings in 2023. We expect to unlock further efficiencies in 2024 and beyond as we implement our new internal Foundry model, which is designed to drive greater transparency and accountability and higher returns on our owners' capital. Remember, when you have a foundry, we've looked at TSMC, for example, Taiwan Semiconductor, we see that they invest a lot in their business. They've been investing a lot in their business for years and years and years. Now, of course, you invest for the next technology or the next technologies, right? But once you go further and further, what happens with the older ones? Well, usually a broken model would mean that you forget about the older ones and then all of your investments are basically gone. You're not making money anymore on those investments. But what we've seen with the likes of TSMC, for example, is that they're still making a large amount of their revenue from older nodes. And that's exactly what we can expect from Intel going forward. Just because they invest now a lot of money for the next coming years, for the next coming nodes, doesn't mean that these nodes won't generate a lot of revenue for the company in years and years to come. Now, they provided a bit more information with regards to IFS. So IFS has taped out more than 75 ecosystem and customer test chips and has more than 50 test chips in the pipeline across 2024 and 2025, 75% of which are on Intel 18A. Intel has also won 3 additional advanced packaging design wins during the 4th quarter. Intel and UMC has also announced a collaboration on the development of a 12-nanometer process platform to address high-growth markets such as mobile, communication, infrastructure, and networking. And the company has also declared a quarterly dividend of 12 cents, which will be payable on March 1st, 2024 to shareholders of record as of February 7, 2024. Now, before continuing, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, would really appreciate that. And if you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. All right, so Q4 results exceeded expectations, beat the market expectations as well. Revenue came in at $15.4 billion, that's up 10% year over year, and $300 million above their own outlook. As for gross margin, 48.8%, up 5 percentage points year over year, and 2.3 percentage points above the October outlook. EPS, 54 cents, up 260% year over year, 10% above the October outlook. When you look at the year over year comparisons here, last year was really a disaster year. Moving on to the most important segment for Intel currently, CCG, Client Computing Group, revenue increased 33% to $8.8 billion, operating income up 451% with an operating margin of 33%. The reason for that increase, healthier alignment of sell-in and sell-through, and the same can be said with operating income. As for Data Center and AI Group, revenue is down 10% year over year, operating income down 38% year over year. They say here CPU TAM contraction, ongoing competitive pressure, and PSG inventory correction is the reason for that performance. Of course, when talking about data centers, you're directly linking it to the likes of NVIDIA, even AMD. NVIDIA has seen immense growth, so why aren't we seeing that with Intel here as well? Remains to be seen what happens with AMD when they report, if they will report a bit of the same weakness or more strength, which means they're taking even more market share from Intel. As for Network and Edge Group, revenue down 24%, operating income down 110%. They say here, continued demand softness and elevated customer inventory is the reason for that. And the last two segments here, IFS and Mobileye. With IFS, revenue is up 63% year over year on accelerated traditional packaging purchases. Operating income loss of $113 million. And the reason there is high investment to support long-term growth. With regards to Mobileye, they've already announced their own weakness, I think a week or two ago. That revenue only increased 13% year over year. With regards to operating income, $242 million with an operating margin of 38%. Now the big issue was this Q1 outlook, because Q4 was a very good quarter for Intel, a very good way to close off a pretty good 2023, all things considered. Now looking at Q1, revenue only up 8% year over year, expected to be between $12.2 and $13.2 billion. Again, Q4 usually a very strong quarter, Q1 seasonally weaker quarter. So yes, the numbers here quarter over quarter wouldn't have been such a great comparison, but still this is around $1 billion lower than most of the analysts' expectations. Not great. With regards to gross margin, 44.5%, up 6.1 percentage points year over year. And here again, EPS only 13 cents. Yes, it's up 425% year over year, but only 13 cents, not good enough. Now, some analysts are saying that we get these numbers because Q4 was such a great quarter that they shipped out way too fast in Q4. That bumped up the number for Q4, and so we're getting hit now in Q1. Others are saying, well, market weakness, seasonality, weaker than expected. Maybe some segments there aren't performing as expected either. So let's hit the stock. Management provided a bit more information during the call. So with regards to Q1 guidance, while they expect a slightly sub-seasonal first quarter from their core product businesses, we see material inventory corrections in Mobileye and PSG. Additionally, we expect a significant drop in IFS revenue after seeing accelerated purchasing in our traditional packaging business and cyclical weakness in wafer equipment buying in the first half of the year, impacting the IMS business. When combined with the businesses we exited in 2023, we expect a roughly $1 billion sequential revenue impact from businesses outside of our core products. You can see this as a positive thing, meaning the core products of Intel are doing fine, the ones outside, not that much. Still, it's a hit, still a huge miss on guidance. With regards to Q1 data center revenue, that is expected to decline double-digit % sequentially before improving through the year. With regards to that, they gave us a bit more information here. So with regards to the accelerator pipeline for 2024, that grew double digits sequentially in Q4 and is now well above $2 billion and growing. They recently increased their supply of both Gaudi 2 and Gaudi 3 to support the growing customer demand, and they expect meaningful revenue acceleration throughout the year. Of course, $2 billion sounds nice, not nearly big enough when you look at the overall opportunity out there. But okay, they have to start somewhere. But at least now we're getting a bit more of a picture of why guidance was so weak. Still not a clear answer. Usually we don't really get clear answers in earnings calls, but now you can do with that information what you want. And so if we look at the graph, we ended the year at, well, close to $50. We were a bit overbought there on the weekly. Then we started the year testing the 20-day moving average. Didn't work. Earnings report, weak guidance, stock crashed 12%. We're now under the 20 and the 50-day moving average. The 200-day moving average, for information, is now at around $39. We're now at $43, close to $43. So if you're looking for a better entry, maybe look at sub $40. Could be a good entry point. Now overall, yes, one bad guidance doesn't mean that the comeback story is over. Far from it. I think from a technology standpoint, they're still proving that they're well on their way back. I don't know if it's the top, but back on track to being an important player in that market, in that industry. I know that at the end of February, they're going to have an event. They're going to provide a bit more information there. Overall, okay, weak guidance. Now let's see 3 months from now if they can beat that guidance, and if the next quarter we're going to get the same story, or this was just a one-time thing and they'll just continue how they ended 2023. Remains to be seen. Right now, overall, not planning on buying a lot more shares, definitely not selling either. I'm just waiting. Of course, do share your thoughts down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.